Carol Tomé, CEO of UPS, it's great to have you on. Thanks for being with us today.
Good to see you, Morgan.
So I do want to start with the fact that for fourth quarter, your earnings beat expectations, but it was really that full year 2025 revenue guidance and operating profit coming in weaker than expected. And then this news about Amazon and the fact that you're going to be tapering some of those volumes here through 2026 that has sent the shares lower. How much of the Amazon business piece of this is factoring into your guidance for 2025?
Well, Morgan, it's great to spend some time with you. And let me just talk a little bit about our Amazon relationship. We've been together for nearly 30 years. They are our largest customer, but they're not our most profitable customer. And the contract with Amazon came up for renewal in 2025, so we stepped back to take a look at where did we want to take this business going forward. Because if we didn't take action, it would have diminishing returns. So we looked at a number of different alternatives and decided that the best thing to do would to accelerate a glide down of their volume, taking it down by more than 50% by June of 2026. What that means in terms of the guidance is simply this. In the United States, our volume will decline in 2025 by 8.5%. Our revenues will decline by about 2%, but our profit will increase by 14.5%.
As you do grow margins and as you do seek out, and I'm going to get into this a little bit more in just a moment, some of these perhaps more profitable areas of business, have you been surprised to see the reaction in the stock today? And UPS is having its worst day on record. I mean, we have in some ways seen this playbook play out before just a couple of years ago when FedEx disentangled itself from its own Amazon contracts.
So we had a big announcement today, and there was a lot for the market to digest. I think as the days and weeks come and analysts and investors digest our news, they will understand that we are taking control of our destiny. We are going to grow in the parts of the market that value our end-to-end network and value the capabilities that we have been investing in that differentiate us from the rest of the market. We are not a shrinking company. We are a growing company, but we need to take control of the Amazon volume.
How do you plan to backfill that volume as it comes down at Amazon, especially given the fact that the last time you and I spoke in March of last year on the heels of your Investor Day, you laid out this 1+2 plan and this better and bolder vision for the company?
Yes, so the 1+2 plan played out beautifully. We ended up with a lot of momentum in 2024, growing revenue and profit. As we think about how we're going to grow going forward, well, the U.S. small package market is growing in the low single-digit area in 2025, and we're going to take share. How are we going to take share? By leveraging the capabilities that we've been investing in. And I'll give you one example. We've seen great growth in our small and medium-sized customer segment. That segment reached now about 29% of our total business in the United States in 2024. And we're going to grow that to 32% in 2025 and then on our way to 35% by 2026. It doesn't stop with SMBs, however. We're growing into cold chain logistics. We just completed the acquisition of another cold chain healthcare logistics company in Germany known as Frigo-Trans. So our healthcare business was pretty growthy last year, and it will continue to grow in 2025. The healthcare business in 2024 grew 5%. In 2025, it's going to grow nearly 8%. And we're on our way to take that business to a $20 billion business by 2026.
Now, you've also said you're going to be reconfiguring the network. You plan to extract $1 billion in cost savings. How does that happen?
So there are different cost out activities associated with the announcements that we made today. We have a lot of assets and resources that support the Amazon volume. And as the Amazon volume comes down, we will be freeing up resources and assets. We'll close about 10% of our buildings throughout the United States as an example of how we're freeing up assets and resources. And clearly, our staffing, well, it flexes with the volume that's inside of our network. On the Efficiency Reimagined announcement that we had today, this is about just improving many of our processes to take out costs. We've got some pretty archaic processes in our company still today. For example, we still take checks. So we've identified over $1 billion of cost savings just by running a better business going forward.
And then just finally, on the e-commerce piece of this specifically, Amazon's certainly getting a lot of attention today, but you have also been delivering more and more packages for some of the Chinese e-commerce players as well. You've brought SurePost in-house, which is a postal service related service as well. So what does that mean for the e-commerce business, the business to consumer business at UPS specifically?
So on SurePost, this is an important product that we offer to our customers, and it's economy product. It made up a little under 20% of our total volume in the fourth quarter. We had used the Postal Service as part of the last mile delivery solution for this product. The Postal Service is changing its operating model and raising its costs. And when we looked at that value proposition, we were nervous about that because, well, they were changing their operating model, which could put service at risk. So we took a look at that and said, hey, we can insource what the Postal Service had been doing for us and make sure that we have excellent customer service for our customers. By the way, we already delivered 50% of the SurePost product, so we're only insourcing the remaining 50%. It's a better value proposition for our customers, and it's a better value proposition for our share owners. In terms of the overall e-commerce market, we are really focused on the customer segments that value our end-to-end integrated network. That's cold chain healthcare logistics, it's small and medium-sized business customers, it's B2B customers. It's differentiating our capabilities to gain stickiness with our customers. In fact, our churn, in other words, the number of customers that left us last year, was the lowest it's been in many, many years. So we're just laser focused on segments and capabilities and not chasing all the packages that are coming into the small package market.
Carol, we just talked about the news and the outlook for 2025. Coming off of a peak holiday season, though, and much stronger than expected numbers for Q4, what is your sense of both the U.S. economy and the global economy right now?
So our sense is that it's pretty good, and the projections for global GDP are in the low single-digit area, which is not bad. The same thing is true for export and industrial manufacturing. I'm pretty excited about what the projections are for industrial manufacturing, because after 7 quarters in a row of decline, it's projected to grow in the 2% area in 2025. So that bodes pretty well for our business and for the economy.
It's interesting to hear you say that, because I've had some of these conversations with other folks in the freight business and transportation business as well. What do you think it takes to see that inflection in the industrial part of the economy?
Well, a lot of it's just that, of course, the demand patterns need to change, and I think they are. Capital dollars being spent are up. Feels pretty good to me.
And then international is an area where you continue to grow as well. So what are you seeing in terms of international business, especially given so much focus right now on trade and the possibility of tariffs?
Yeah, so we had a terrific fourth quarter in our international business where our domestic and our export average daily volume returned to growth. We also saw strong revenue quality and strong earnings, printing $1 billion of profit out of our international business and a margin of 21.6%. So it was just a great way to exit. And as we look to 2025, the market is projected to grow in the mid-single digits, and we're expecting to take share as the market grows. Now, as it relates to tariffs and trade, trade follows policy, and tariffs generally are not good for trade. But here's the thing about UPS I think is important to note. In terms of our risk, if you will, last year we delivered 22.4 million packages a day. Of that, less than 400,000 packages were imported into the United States from countries like Canada, China, Europe, Mexico. So our risk exposure for our small package business is pretty small. As it relates to shippers broadly, they have lots of choices if tariffs are placed against them. They can do nothing and absorb the cost. They can pass the cost along, or they can look at other alternatives. Those alternatives might be a change in mode. In other words, moving from high premium air to perhaps ocean freight. Or they can look at changing destination, not delivering to countries that are charging the tariffs. So they can look at changing origin, moving to manufacturing sites to other countries. And we got ahead of that, Morgan, a couple of years ago when we saw China plus one strategy happening with many manufacturers who weren't leaving China, but they were moving manufacturing to other countries like Vietnam. So we expanded our capabilities in countries like Vietnam, and we're seeing 20, 30% growth in those trade lanes. So the beauty of having a global integrated transportation network is that we can handle our shippers whatever they decide to do if tariffs come their way.
Do you expect that dynamic to continue? And if so, what does it mean in terms of how you're planning out future investments in your own network globally?
So it's hard to tell. There's a lot of noise right now with tariffs, but we do know a few things. We do know that the largest trade lanes are in Asia. So we've announced an expansion of our airport in Hong Kong, and we're building a brand new gateway in the Philippines. So we'll be able to take advantage of those growing trade lanes.
And then finally, labor. You had the high-profile contract that was struck, I guess, about a year and a half ago. Now, what does that mean in terms of how it's factoring into your costs as you do focus on things like growing margins?
So the beauty of the labor contract that we negotiated last year is that we have certainty regarding our costs. It was a front-loaded contract, but that first year of the contract is behind us. The average annual cost of the contract is 3.3%. And we saw that in the fourth quarter where our labor costs just rose 3%. And that then gives us certainty as we plan for the future. Then hours and the staffing that we use inside of our business will fluctuate versus the volume in our network. But in terms of the underlying costs, we have clarity as to what that is, and that's factored into our guidance.